Hello guys, in today's video I'm going to talk about a fairly simple strategy that will be a very helpful tool for all of you who are barely starting with the trading or are in a couple months of your journey with trading on financial markets. So this strategy is mostly based on the indicators, but we will talk about also how you can add your, for example, simple analysis that you can conduct on yourself without using any indicators. Okay, so now without further ado, let's switch to the trading platform and discuss what is the strategy about, of course. So now we are in the trading view. And the first thing that you might notice is that we have a couple lines, couple indicators, so on and so forth. And this is gold chart, and this is 1 hour chart, 1 hour time frame of gold. So maybe let's switch off those indicators and let's discuss a pure chart that we have here. So clearly, first, and what you can notice is that we are here in a clear downtrend. So as in many of the strategies, most of the time we want to open, we want to open short positions when we are in a downtrend and long positions when we are in an uptrend. So what I am talking about, we want to look for the moments when the trend is clearly down and when price is making a small correction. So in order for us to have a better price, we can say a better price level at which we can enter our trade. So first thing that we will add to the chart in order to determine what kind of trend this is, because you know, guys, it's fairly simple to make mistakes when determining the trend, because on one hand we can see that okay, this is a downtrend right here, for example, but if we zoom out, maybe it is not in this situation. If we zoom out, yeah, it is still a downtrend. Okay, but what I wanted to talk about, for example, if you will zoom out, it might turn out that the trend, this we can say fraction of the chart that you're looking at the moment, is, for example, clearly the opposite trend direction to the bigger trend that is on the chart. So maybe let me show you what I am talking about. Okay, so let's say, for example, we are analyzing this moment here. You can see, okay, this is clearly an uptrend, right? But if you will zoom out, what you can see from the bigger horizon, bigger perspective, it is a downtrend. So in order for us to, eliminate that mistake and have some rigid rules, a rigid tool that we can use to determine the trend direction, is of course exponential moving average. So we are going to indicators, you type EMA, this is the trading view station, but you can also find moving averages on particularly every other trading platform. So you type EMA, exponential moving average, or here is moving average exponential. You set the period for 150 candles. So basically it analyzes last 150 periods, and based on that, it determines its level, right? Its direction of movement. So let's go for the period that I have here prepared. So that's the first thing, the exponential moving average. The second thing that we are going to use is the Bollinger Bands trading indicator. And so as for the Bollinger Bands, it's again fairly simple indicator. We have, maybe let's delete the moving average. We have upper and lower band, and we have this, we can say, middle moving average in the middle, right? So I didn't change any of the settings of the Bollinger Band, so these are basically the default settings. Most likely it's in all of the trading platforms, the numbers, the settings are the same, so don't worry, it will work in your platform as well, I'm sure of it. So next step is that, of course, we are looking for the moments. If you can see the Bollinger Bands, and you can guess maybe as well by now that we are looking for moments when the price is crossing the Bollinger Bands and going back inside the Bollinger Bands, inside the channel. Okay guys, so right here, in this moment, maybe you could ask why we should not only use a Bollinger Bands with the exponential moving average. And I will show you why exactly. Because for example, we could have situation like this. When the price went above the Bollinger Band, went back inside the channel, and again, it was the price went above the Bollinger Bands in with this candle. So if we would just use Bollinger Bands and the exponential moving average, okay, we are looking at a short opportunity. So we would open a transaction at the level of opening of the next candle, that is the next one after the candle that we saw this move above the Bollinger Bands and inside the Bollinger Bands. So we would open the transaction over here. So our stop loss would be couple pips above the recent we can say recent high. So we have this moment over here or this candle over here. So let's say whatever, it can be this level right here. And so we are using, as always, minimum 2-to-1 risk reward ratio. So you can see right here, this trade would not work. So in order for us to avoid such a mistakes, we will add the third indicator, which is a stochastic indicator. And so when using a stochastic indicator, you will notice that, yeah, in this moment, maybe let's mark it a little bit better. We are talking about this candle over here. So you can see that, okay, the price went above the Bollinger Band. So we might think, okay, this is a good opportunity, but yet stochastic didn't give us the signal at all, because we are taking the signals from stochastic only when the price only when the indicator will go into the overbought or oversold zone, depending on the trend direction, and the lines will cross. So we can see that the stochastic wasn't even in the overbought zone. So therefore, it would filter for us, for example, this mistake. Okay, so now let's talk about the full strategy. So first, we have determined the trend direction, which is down because the price is below the moving average, the 150 period moving average. Next, we are looking at the Bollinger Bands. And so we see over here that, okay, the price went above with this candle. The Bollinger Bands still is above. We see the stochastic is in overbought zone. Okay, the lines crossed each other. The blue line crossed the orange line from the top to the bottom. So the first, we can say, the first, which is a downtrend, the second, which is a stochastic indicator, gave us the signal, but third, we must wait for the price to go back inside the Bollinger Bands. So this candle didn't went back in, and the price in this candle went back inside the Bollinger Bands channel, therefore giving us a signal that, okay, the price closed here, so we are opening our trade at the opening of the next candle. So this is the level where we are opening. And again, as for the stop loss, we are looking at the nearest high because we are talking about the short trade. So as we can see if we check the left side, this is our recent top. Right here, we had clear downward movement without any retraction, without any bigger consolidation. We must go for the left side. So this is around those level 1670. So it is much lower than our entry point. So we will use this level and this particular candle, this higher high. So this lower high, sorry. So we have this at 1684. So let's add a couple pips more. Okay, so we have added a couple points to our stop loss and of course a risk reward ratio 2-to-1. Okay, so it's 0.99. So yeah, you can see that this trade would be profitable over here. So now let's go further and check what examples we have after that and discuss maybe what is important to follow the rules. Because for example, we have the moments like here, okay, but we wouldn't take this opportunity because the stochastic wouldn't show us the levels of overbought zone. But if you would take this opportunity, so the price went up and closed over here, so we would enter over here. If we check the left side, again, for us, these are the levels where we would open a transaction. So add couple pips and risk reward ratio 2:1. So you can see this trade, if we stretch it to the right side, would be unprofitable. We would be stopped out over here because, as I said, we had the signal from the Bollinger Bands, but the stochastic showed us that this is not the moment where we should enter the market. But yeah, all the other two signals were correct. We are in the downtrend, so we are looking for short. The Bollinger Bands are signaling the price is going outside the Bollinger Bands, getting back inside. But yeah, it didn't work out this time. Okay, so we have the moment over here where we have this movement where the price went outside the Bollinger Bands channel, outside the upper Bollinger Band. So we can see here that okay, it would give us a short opportunity, but stochastic told us not to. That's the first case. Second case as well. We went outside. We went inside or at the level of right at the border of this upper Bollinger Band. But stochastic again didn't went inside the overbought zone. If we go further down the line, you can see as well. We have the signal from stochastic. The price is in the overbought zone. We are below the 150 period moving average. But again, we are not at the price didn't went outside and back inside the Bollinger Band. Therefore, we are not entering this trade. And so as for a long trade, it goes the same, only we have inverted all the rules. So therefore, the price will have to be above the 150 period moving average. The price also should went outside the lower Bollinger Band, get back inside, and the stochastic would have to be in the oversold zone. So maybe let's check if we will find out, because this is a clear downtrend. Let's check if we will find out some good example for a long trade. Okay, that would be a good example. So we have two already over here. So let's check the first one on the left. So we have the situation over here that we have a clear short-term downtrend. So the price went outside the Bollinger Bands, again closed outside, again the candle closed outside, again closed outside or at the Bollinger Band, again closed outside, and this one closed first, this first candle closed inside the Bollinger Bands channel. So we are, and we see on the right here down below that the stochastic lines were crossed here and again over here. So the first one is fairly enough for us. So we would enter at the opening of this first candle. So this candle closed inside, therefore we are opening at the level of opening of the next candle. So it is over here. As for the stop loss, again we are looking at the left side. This is our nearest lowest point. So let's check the left side. Maybe we could use this one over here. So again, this is the level. Let's add a couple pips. And again, 2:1 risk reward ratio. So over here. And we can see clearly that the trade was analyzed correctly, and therefore it would close with a profit. Again, we look for the next situation, which is right beside over here. So we had this two strong red candles. The price with the notch the price during the creation of this red candle break out of the lower Bollinger Band, went inside and closed inside the channel. So again, we would open at the next candle, but we still wait for the crossing of the stochastic lines. So not at this candle, but at the closing of this candle over here. So you can see down below, right here, the lines crossed each other. It was even inside the neutral zone. So the opening of the next candle is our entry level. So again, let's yes, this candle. So we would open over here. As for the stop loss, I think we could use the low of this red candle. So it is over here. Let's add a couple points, and again, 2-to-1 minimum. And this trade also would be profitable. So that would be it as for this strategy for today, guys. I hope you like this one because it is fairly simple in use. So yeah, it would be a great tool for you in order to, get along with the markets and start to, generating at least some small profits from your accounts if you will, use all three methods, all three rules from this strategy. So as you saw, all the indicators are always, I think, in any of the trading platform which you will be using. Therefore, it will be no problem for you to use it.